So we have spent quite a bit of time going through this earnings season, reading results, listening to con calls and trying to figure out businesses and their growth. And you know what? This earnings season, we found something really compelling. There are companies out there telling investors, give us just 3 or 4 years and we could potentially double our profits. Yes, double their profits. Now, whenever a management team makes a claim this big, I think there's only one question worth asking. What makes them so confident? Is the business already showing signs? Are there new products, new capacity, or new markets that can actually drive it? Or is there just an ambitious target that sounds good on a con call? So we went through the latest results with these exact questions, and we found 6 companies making some very big growth bets. We look at what the business does today, what's changing inside the business, where this next phase of growth is supposed to come from, and what could stop it from happening. And most importantly, we look at whether the numbers and the building blocks we can see today actually support the growth that management is promising. So let's get right into it and start with stock number 1, Gravita India. You would normally think a recycling company grows by simply recycling more waste. But that's not really how Gravita's growth is playing out. It's making more money from the same amount of scrap. So Gravita started as a lead recycler, but today it works across lead, aluminium, plastic, copper, rubber, and even lithium-ion batteries. It also has plants across India, Africa, Europe, and Asia. And to keep all of these plants supplied, it has built a large scrap collection network with more than 2,200 touch points and 39 of its own yards, giving it access to more than 3.3 lakh tons of scrap. In the June quarter, 63% of its revenue came from value-added products or the higher margin products. And while the volumes increased by just 4%, revenue jumped 42% to 1,475 crore. That means most of the growth isn't coming from simply processing more scrap, it's coming from a better product mix and better pricing. And management wants to keep this going. It's targeting 25 to 30% profit growth every year for the next 4 to 5 years, which would mean profits could roughly double in 3 years. Now, there are 2 things that could help them get there. The first one is capacity. Gravita currently has around 5 lakh tons of installed capacity and wants to take that beyond 8 lakh tons by FY29. But what's interesting is that current utilization is only around 52%. So some of the near-term growth can come simply from using the capacity it already has more efficiently even before spending heavily on new plants. The second opportunity is copper. Gravita recently bought a 99% stake in Rashtriya Metal Industries for 562 crore. The company has been around since 1946 and makes copper sheets, foils and brass components for electrical and defense customers. Last year, it generated around 1,000 crore in revenue and 82 crore in EBITDA. And it's currently running at only around 50% utilization. Management wants to double its copper capacity to 60,000 tons over the next 3 years and increase profitability per ton from around 55,000 to around 70,000. But yes, there are risks too. Around 50 to 20% of Gravita's imported scrap comes through the Gulf, and disruption there affected lead volumes this quarter itself. The business also needs a lot of working capital. Overseas operations come with regulatory risks, and aluminium and plastic prices can move sharply. Now, at around 1,788 rupees per share, the stock trades at roughly 33.7 times earnings and 5.4 times book value with a market cap of around 13,200 crore. So the market is already expecting a lot from Gravita. We need to keep tracking the execution here on. Now let's move on to stock number 2, Privi Speciality Chemicals. Now, to understand this business, think about something as simple as the smell of your favorite perfume or the flavor of a chocolate bar. A tiny amount of a specialized chemical can be responsible for that smell or taste. Privi makes more than 75 of these aroma chemicals and sells them across more than 40 countries. But what makes the business really interesting is where it gets its raw material from. Around 70% of its raw material is renewable. Privi takes crude sulfate turpentine, which is basically a byproduct of the paper industry, and uses chemistry to turn it into ingredients used in perfumes and flavors. And this isn't a business it built overnight. Privi has spent more than 30 years developing its processes, plants, and sourcing relationships. Because it uses this relatively low-cost raw material instead of the more expensive alternatives used by the other companies, it has a 15 to 20% cost advantage. Its plants are already running at around 90% capacity, and you can see that advantage in the numbers too. June quarter revenue grew 20% to 681 crore, while profit grew even faster, up 36% to 84 crore. So where does the next leg of growth come from? One part is capacity. Privi is increasing capacity from around 48,000 to 54,000 tons with more expansion planned later. But the bigger opportunity could be new higher value products. The company is currently working on more than 10 new molecules, and that matters because more than 95% of the global supply of these molecules currently comes from China. So, as global customers look to diversify their supply chains, an Indian company with a cost advantage could have a real opportunity to gain market share. Management believes this new product line alone could eventually add more than 1,000 crore in revenue. And then there is another piece to the story as well, a joint venture with Givaudan, one of the world's biggest fragrance companies. The JV has now turned profitable and supplies more than 40 products exclusively to them. Management is targeting 5,000 crore of revenue and more than 1,000 crore of EBITDA by FY 29-30. That's roughly doubling the business while maintaining margins above 20%. But again, there are risks too. Raw material prices can move around, working capital is relatively high, and the company has around 1,200 crore of capex planned over the next couple of years. Privi has a market cap of roughly 14,000 crore, and the stock is trading at around 3,584 rupees at roughly 40 times earnings. So once again, the market is already pricing in a good amount of future growth. Now let's move on to the third company, RateGain. Now you've probably noticed that hotel prices don't stay fixed. The same room can cost more or less depending on the day or sometimes even the hour. A lot of those pricing decisions happen through software, and that's where RateGain comes in. It provides technology to hotels, airlines and car rental companies. And the scale is already significant. It works with 33 of the world's top 40 hotel chains, 4 of the top 5 airlines and 7 of the top 10 car rental companies. The June quarter numbers were huge. Revenue jumped 188% to 785 crore, EBITDA nearly grew 4 times, and profit grew 149%. But there's an important reason behind that jump. RateGain acquired Sojern in 2025, which helps hotels find travelers who are actively planning trips and turn that interest into bookings. The acquisition has added around 13,000 customers, but the bigger opportunity isn't just the new customers, it's what RateGain can now sell them. Now think of it like this, a hotel might first come to Sojern to attract travelers and then use RateGain's pricing, booking and guest engagement tools as well. In other words, one customer can now buy much more from the same company. Management is targeting around 3,000 crore of revenue for the full year, and after delivering 785 crore in the first quarter, it has said it is confident of beating the top end. It has also raised its EBITDA margin guidance to 22.5%. RateGain is also using AI to go beyond simply analyzing data. It's increasingly using AI to make pricing and inventory decisions automatically. But of course, there are risks. Travel demand can slow, competition is intense, and the big question is whether Sojern can continue growing at this pace once the initial acquisition boost starts fading. RateGain has a market cap of roughly 10,800 crore and trades at around 900 rupees with around 41 times earnings. Now let's move on to stock number 4, Edelweiss Financial Services. Now, this is a business transformation that's hard to ignore. 5 years ago, Edelweiss Financial Services had an 18,000 crore wholesale lending book. Today, it's down to just 600 crore. That's not a small change. The company has essentially walked away from a business that was once at the center of the group. So where has all that focus gone now? Into the businesses where Edelweiss earns fees without taking the same level of lending risk, like asset management, stressed asset recovery, insurance, and more selective retail lending. Today, the group has 7 businesses, 14 million customers, and manages 2.8 lakh crore of customer assets. And this quarter gave us a glimpse of what that transformation could mean. Consolidated profit jumped 83% to 122 crore. The asset management business grew profit 45%, mutual fund profit grew 33%, and general insurance premiums grew 58%. What makes this interesting is that the newer businesses are already growing fast. EAAA, which is its alternative asset management business, is seeing strong growth, and the mutual fund business is also growing quickly. So now there are 3 potential triggers to watch from here. First, EAAA is expected to list separately around the December quarter. Since it's already one of the fastest growing business in the group, a separate listing could make its value much easier for investors to see. Second, global investment firm Carlyle is investing around 1,500 crore into Edelweiss's housing finance business, which is Nido. The deal is expected to close around September 26 and would give Nido fresh capital to grow without relying as heavily on Edelweiss's balance sheet. And the third one is, both its general and life insurance businesses are still loss-making, but management expects both to reach break-even. Now, general insurance is already showing strong momentum with premiums up 58%. So, even getting these businesses from losses to break even could directly lift group profits. But there is still one big if here. The insurance businesses reaching break even is still a management expectation, not something that has happened yet. So, that needs to be tracked closely. Edelweiss currently has a market cap of around 11,259 crore. It trades at roughly 18 times earnings and has an ROE of around 13.5%. Now let's move on to the next stock on the list, Neuland Laboratories. It's a Hyderabad-based company, but its products ultimately go into medicines sold across more than 80 countries. 92% of its revenue currently comes from outside India. Over the last decade, Neuland has moved up the value chain. It has gone from making relatively basic pharmaceutical ingredients to developing and manufacturing much more complex molecules for global pharma companies. This custom manufacturing business now contributes 67% of revenue, and that shift showed up very clearly in the June quarter. Revenue grew 116% to 650 crore, EBITDA jumped 448%, and profit increased almost 10 times. Now, management has been very clear that the business can be lumpy, so investors shouldn't assume this exact growth rate will continue every quarter. The better question is what supports growth over the next few years. Neuland currently has 99 active projects in its pipeline, with 19 already commercialized. These projects are at different stages from clinical trials to commercial manufacturing. Management is targeting around 20% growth in both FY27 and 28. One area that could become particularly important is peptides. These are basically complex drug ingredients increasingly used in diabetes and obesity treatments, and demand from them is growing rapidly. Neuland has been building expertise in peptides for more than 15 years and is now setting up a dedicated commercial scale facility with projects already lined up. But the biggest reason global pharma companies trust Neuland is its track record. It has more than 40 years of experience, approvals from major global regulators, and has cleared 18 consecutive US FDA inspections with zero observations. That's not easy to achieve, especially when you're manufacturing complex medicines for global customers. If Neuland can grow profits at around 20% a year, they could roughly double in 4 years, which is broadly in line with management's long-term target and its goal of maintaining margins above 25%. But again, the market already knows this story. At a market cap of around 29,500 crore, the stock trades at nearly 59 times earnings. And because around 95% of revenue comes from highly regulated markets, any compliance issue could have a significant impact. Debt and future capex are also worth watching here. Now let's look at the final company on our list, Ramkrishna Forgings. Now this is probably the biggest turnaround story in the entire list. A few years ago, the company had excess capacity, high debt, and weak returns. Today, management is targeting 8,000 crore of revenue by FY29, compared with around 4,200 crore in FY26. That's roughly 22 to 25% annual growth for 3 years. But what makes this story different is that the company doesn't need to build an entirely new manufacturing base to get there. A lot of the capacity is already in place. The focus now is on filling those plants with more orders, improving utilization, growing exports, and moving towards higher value products. Ramkrishna makes forged and machined metal components, basically taking steel, heating it, and shaping it under extreme pressure into parts used in trucks, cars, railways, mining, and other industrial equipment. It has 20 facilities across India and Mexico with total capacity of around 3.96 lakh tons. And FY27 started very well. Q1 revenue grew 20% to around 1,200 crore, EBITDA jumped 47%, and profit nearly tripled. The first major growth lever is capacity utilization. After 2 years of heavy investment, utilization was around 68% this quarter. Management wants to take that to 75 to 80% before starting another major capex cycle. So a meaningful part of the growth could come simply from getting more out of the factories it has already built. The second lever here is diversification. Commercial vehicles are still the biggest part of the business, but the company is expanding into passenger vehicles, railways, mining, construction, and agricultural equipment. It won 293 crore of new orders this quarter, and exports are another opportunity, with management expecting more than 22% export growth this year. And exports generally carry better margins than domestic sales. And the company is also moving into different components for aerospace and semiconductors, with aluminium already in commercial production. But this is where I'd be a little careful. The expansion has come with significant debt. Net adjusted debt to EBITDA was around 4.6 times in FY26, and the working capital cycle is around 193 days, meaning a lot of cash remains tied up in the business. Management wants to reduce net debt by around 500 crore this year, and that deleveraging is just as important as the growth numbers. The valuation also leaves very little room for disappointment. At a market cap of around 13,700 crore, the stock trades at nearly 119 times earnings, while ROC is only around 5.6%. That gap between the valuation and the current return on capital is something investors need to keep a very close eye on. So these were the 6 companies. 6 completely different businesses, but there's one common thread running through all of them. Every management team has put a very specific growth number on the table, but saying that number on a con call doesn't make it happen. What matters is whether the things that are supposed to drive that growth are already starting to show up. And that's probably the most important takeaway from all these 6 companies. Don't just listen to the guidance, look for the building blocks behind it. Do you want us to cover more such earnings analysis? If yes, comment earnings. And if you found this video helpful, then do like it, share it, and subscribe for more such videos. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.